Anytime you're not putting 20% down, you have to pay an insurance that insures the lender against you going into default. That's all it does. It's money you spend as part of your monthly payment that is telling the lender, hey, if I become irresponsible and I can't pay you, there's an insurance company out there that's backing this mortgage that's going to help Waterstone or any one of our partners that we may sell loans to recover or recoup losses. Now, just like any insurance claim, if anyone's ever had an insurance claim, insurance companies love to deny your claims. Insurance companies are for-profit organizations. That being said, the first thing they're going to do is make sure that there's no deficiencies on the file. If you ever want to know why do we have to dot I's in purple ink and cross T's in pink ink, it's because at the end of the day, we are a for-profit business. The last thing we ever want to do is underwrite a loan, approve it, fund it, have it go delinquent, turn around to our insurance provider and say, hey, you remember that policy that you wrote for us, and have them look at our work and be like, this is garbage. You didn't follow protocol. You didn't follow the rules and the guidelines. Or worse, you thought you followed them, you just misinterpreted them. And that's what happens with PMI. But what is PMI? PMI is nothing more than an insurance policy that protects lenders against borrowers going into default. You have to pay PMI whenever you put less than 20% down. There's some form of PMI. Now, the P stands for private, M stands for mortgage, I stands for insurance. So you technically only have PMI on loans that aren't loans that end in A. Not FHA, not VA, not USDA. Conventional. Or sometimes jumbo, right? So jumbo would be called non-conforming. It's a non-conforming loan. In the secondary market, we call them PLS, or private label security. That just means it's not Fannie or Freddie, but it's also not a government loan. So that just makes it a private loan. We have investors, Eric's locking a loan right now, Asia, with PenFed. So PenFed's an investor. It's a jumbo loan, it's a $920,000 loan. That loan may have mortgage insurance on it, so it may have PMI on it, but it's not Fannie Freddie, meaning it's not conventional. It's also not a G loan. The G loan, or the A loans, VA, FHA, USDA, they have some kind of insurance on them, but it's not PMI. FHA will have an upfront mortgage insurance premium as well as a monthly mortgage insurance premium. We'll get into that because I do want to teach you all how to calculate an FHA payment. A VA loan has a VA funding fee, so it's a big fat amount of money that gets financed into the new loan, but there's nothing monthly for the consumer to pay, for the veteran to pay, our borrower to pay. And USDA has an upfront fee and a tiny, tiny little monthly fee that the consumer has to pay on those loans as well. But none of that is deemed PMI, because PMI is private mortgage insurance. There are 6 mortgage insurance companies that Waterstone partners with, 6 major ones in the US. Right, so if we're talking about auto insurance, we all can name Geico, Liberty Mutual, State Farm, etc. In the mortgage industry, we're going to talk about Genworth, we're going to talk about Arch, we're going to talk about Essent, we're going to talk about National, we're talking about Radian, we're going to talk about MGIC. 6 different mortgage insurance companies. They all do the same thing, but some days one is cheaper than the other. Some days one isn't. What makes us unique here at Waterstone is we allow our originators to shop for the cheapest mortgage insurance for their client. Not every mortgage insurance company does that. When I got in the business, and this is how I thought things were done, I was taught 0.32, 0.52, 0.78. Those were what they called your PMI factors. If someone put down 15%, the PMI factor was 0.32. Cheap. If someone put down 10%, the PMI factor was 0.52, a little bit more expensive. If someone put down 5%, the PMI factor was 0.78, more expensive, right? Because PMI is an insurance. So just like my 16-year-old son, his car insurance is more expensive than my wife's. Throw a DUI on there, and his is through the roof. Throw a DUI and a Corvette on there, and oh my God, we're paying more for his insurance than we are for our house. PMI is just that. Put 5% down, your PMI is more expensive than you put 10 down. Put 15 down, it's that much more expensive. Come to the table with a 660 credit score versus 760, you're gonna pay more in PMI. But wait a minute, slap on a second borrower, maybe I'll give you a slight discount. Be self-employed. Some PMI companies won't like that. Some PMI companies may charge you more because you're self-employed. Like there's so many investment property, yeah, right, good luck. We may advertise that we can do an investment property 15% down, no such thing. When you start looking at the pricing of that loan, you just don't do it. But I think that's just a good overall understanding of PMI, like what it is, right? It's insurance that protects lenders against you going in default. It's an insurance, so it has risk-based pricing. PMI, you can get removed. You can get removed because you paid your loan down. You can get removed because your home appreciated in value and you had your home reappraised. PMI can be removed. FHA's MMI, currently, that's just forever. Like ever. But, so you refinance. But one of the changes our government's trying to make is to quit making FHA forever. So imagine if they made FHA's mortgage insurance half the cost and not forever. How many more of our borrowers would we be more willing to say, hey, an FHA loan is the best loan for you? Right now, FHA is a great loan for some borrowers. Like we tell loan officers, Waterstone's a great place to work for some loan officers, not for all. FHA is a great loan for some. Look, you have a 52 DTI, great loan. You have a 680 credit score, you're putting minimum down, great loan. You had a short sale 3 years ago or a bankruptcy 2 years ago, great loan. It is definitely a great loan, but if you're coming to the table with 5% down, a 780 credit score, and a 20% debt to income ratio, probably not the best loan for you. I can probably find you a better loan.